Okay, good morning, everybody. It's suddenly January 19th. We're already a few weeks into January. The signals are starting to percolate in. And what's really fascinating this spring is this winter and spring is how the market slowed so dramatically last fall. And it seemed like economy fears and inflation fears and rising mortgage rates were going to really stifle homebuyer demand. What we're seeing right now is a lot of anecdotes about buyer interest this spring. And we're going to spend a little bit of time on those things today. Before I dive into the data, a little housekeeping. We have a ton of people on the webinar today. As I mentioned, we had over 2,000 people register. And so these are recorded. You'll get your email for everybody who registered. You'll get your email today with the recording. As we go on, we use the chat during the webinar. There's Lael and Jeff from the Altos team that are in the chat. So if you have questions along the way, questions about the data, questions about any of the slides, drop them in the chat, and Jeff and Lael will try to answer them as we go along. You can always email the sales team at Altos Research, sales@altosresearch.com, to follow up, go deeper, look at your own markets, those kind of things. And so we'll use the chat today. I will stick around at the end and try to make sure we've got everything handled in the chat as well. And so let's get started. And at Altos, we track every home for sale in the country every week, all the supply and demand, all the pricing, all the changes in that data. And this is what we're bubbling up each week. So for January, what we get is we got a couple of weeks of data in January. We can see the first uptick after the New Year's holiday. And between this week and the next couple of weeks, we'll really start to see the new spring inventory come on. We'll see where it's priced. And the pricing there is a reflection of how much demand we're seeing right now. And so we can already start to see some of the leading indicators. And then over the next few weeks, they're going to be really strong for the rest of the year. And as I mentioned, we've been hearing a lot of anecdotes about from realtors in local markets around the country with surprising levels of demand, buyers, traffic in the open house, multiple offers in some cases. Really fascinating to see. And we'll see where that shows up in the data. And what we'll do is, when you're in a place where you're talking to buyers and sellers, especially this spring, about the market, everybody has opinions about what's happening. In most of the country, most buyers and sellers in the US right now have an opinion that the housing market is really slow, that maybe even it's tanking from here. That would be, if you're just watching the headlines, that'd be the impression you get. Home prices are falling and demand, there's no buyer demand, the market is crashing. These are the kind of headlines you're going to get. And so what we're going to do today is look at the data and show how we communicate to people with that impression, with exactly what is actually happening right now. And then we're also going to I'll try to point out the places where you can look at the data as we go forward in the spring to help people make decisions based on how things are behaving in the local markets. In the local markets, there are some very different behaviors that have been happening. though interestingly, some of those little green shoots about decent buyer demand this spring are starting to happen really across the country. But I'm going to try to spend more time in the local markets today. If I don't get to your market today, because we can't get to them all, you can always reach out to Altos Research. You go to altosresearch.com, book time with our team. When you sign up for Altos, you get your local market data. And the first thing we do is we help you walk through your local market, how you're going to communicate to your people right now. You onboard with our team to really get that level of local insight to bring to your clients. We do have, and as we go through the data today, Altos has an ebook. And so everything I talk about in the data is really captured in the ebook, how to talk about the data, how to use the data in your business. So you can go to, there's a link, Lael will post a link in the chat right now. There's an ebook link. So as you're watching me talk about the data, go grab that ebook if you haven't gotten it already, so that you can look at the scripts and the framing and how to describe the data for people who have questions about it. That's really useful. It's free. Go get that. Okay, let's move into the data right now. Let's start with mortgage rates this time. Mortgage rates this week ticked up a little bit to about 6.4%. They fell pretty dramatically as the news of inflation has started to come in, like softer inflation numbers. The CPI, the Consumer Price Index, has been down. All of those things have been leading to lower long-term interest rates and therefore lower mortgage rates. The observation, the thing that we're really looking for this year is that we could see last fall, there's a sort of a threshold at 5.5%. Once mortgage rates jumped over 5.5, 6, 6.5, 7, 7.5 last fall, that's when buyer demand stopped really cold. As the rates have come way off that peak, we can start to see people are interested. And then, and so we're bouncing around in the sixes. I'll talk about inventory in a few minutes. And when we look at inventory, assuming that rates stay in the sixes, that's where we're seeing a mildly a mild amount of buyer demand. If they fall into the fives, I expect to see buyer demand really pick up a lot more than is baked into any of the forecasts around the country right now. So this mortgage rate's really something to keep an eye on. Interestingly, I was talking to my friend Dan Green at homebuyer.com last week, and Dan points out that for folks like first-time home buyers whose income is lower than the average for the region, there are actually federal programs that lower the rate by a point or more. So in the fives or maybe even in the fours for first-time home buyers. And all of a sudden there is affordability things that start to look very attractive. So mortgage rates are going to be key this year. If they bounce over 7 and stay over 7, then I think you're going to see slower. The forecast is going to start. They're going to start. We're going to have to start modifying them down lower. That's where we are right now on mortgage rates. Let's go to inventory. National inventory of homes for sale. There's currently 473,000 single-family homes on the market across the country. That actually ticked up a little bit this week, and it's at the far right end of the chart there. It's such a small uptick. It doesn't even show up on this chart, this multi-year chart. But of course, the things to keep in mind with inventory is that we have 36% fewer homes than we did in January 2020. And so before the pandemic hit, so 36% fewer, even though we are significantly higher than last year at this time. Last year in this time, we had rates were still at 3%. People were buying everything they could. The frenzy was just about to hit its peak before it turned the corner in March and April. In general, inventory is still relatively tight, historically tight. And that means that buyers in the market right now have less competition than they did last year. Maybe, you know, those folks who got outbid on multiple offer scenarios by several times, like that they may find that they have better opportunity this year. There is nothing in the data that indicates a big surge of inventory coming. Inventory is falling, and normal years, and you can see in the little chart, normal years, inventory starts ticking up in January, right where we are now. In the last 2 years, inventory kept falling. During the pandemic, when rates were ultra low, inventory kept falling in January, February, March, because we were buying everything in sight. Now, when that's not true, inventory is starting to tick up, and in a much more normal seasonal pattern. So we can see a much more normal year in inventory demand and supply this year. Let's look at inventory from another couple of angles. When the interesting thing that's happening right now is not really a buyer story, it's a seller story. So we have 46,000 single-family homes, new listings this week. Of those, a handful went into contract immediately, and the rest are still on the market. At the far right end of the chart, each bar here in this chart is a week with the count of new listings in that week. And of course, the holidays are the lowest, New Year's, and then we start ticking up in January through July 1 before the year starts cycling down again. In this chart, the light portion of the bar are the immediate sales, those that got listed and went into contract essentially immediately. Sometimes it's within hours or a couple of days. And during the pandemic, the defining characteristic were these immediate sales. Things were getting listed, taking offers, multiple offers, and going into contract 2 days later. So last year this time, there were 56,000 new listings, but 17,000 of them sold immediately. So now there's significantly fewer that actually are on the market. This year, fewer new listings, fewer sellers, but fewer of those going into contract. So we actually have fewer sellers than we did last year at this time, fewer new listings coming to market. And that is the thing that is keeping a lid on supply and demand and supply, on the supply side of the supply and demand equation. So, you know, when we think about, you know, the folks that we're dealing with, buyers and sellers who think they know that there's a housing crash happening. They've read a bunch of headlines and they think housing crashes, prices must be cratering. One of the things to help them see is that prices are a function of supply and demand, and new supply, all of the signals of new supply are very low. So that supply side of the supply demand equation will continue to keep any like a floor on any kind of price challenge. Now, there's definitely markets where home prices have adjusted down. There's some that are still adjusting down. I'm going to show you a few of those later. So, but the crisis fear, when you look at it in terms of supply and demand, all the signals right now are that supply stays very limited. And that's, of course, because homeowners in the country have very cheap mortgages. They're locked into ultra low rates. And even the markets where inventory rose dramatically last year, even those, we can see those starting to tick down, and I'll show some of those. So this is the new listings, and you really can see it in the new listings week over week, how few there are, even compared to the middle of the pandemic. So then we put it all together, and we have a little bit of a forecast, a projection for how inventory might end up during the year. In this chart, every line here is a year. And you can see that the inventory starts low, it scales up in the first quarter, and then really in the second quarter, peaks usually sometime around August, September, and then starts curving back down. The last few years have been so wild. The yellow line, that's 2020, inventory just kept falling. We kept buying all the way through December. 2021 and 22 started way low, ultra low. We had few listings and we had buying everything. And then the sort of light red line there was last year. And you can see inventory climbed dramatically April, May, June, July. You can also see that in September and October, inventory climbed again when rates spiked over 7.5%, 7.5%. So the dotted line is what we can forecast for this year. We've already got a couple of weeks on the chart. Normal years, inventory starts climbing in January, like now. Last year, inventory kept falling until March. That was unusual. If we find that rates are 7 or 7.5%, my guess is that what happens is we have fewer demand. We have fewer things. We have like investors whose the math on a investment property doesn't pencil out when rates are higher. And so you have more supply come to market and you have less demand. And so if rates start to go, especially over 6.5 to 7, like I said, you'll see this line will get adjusted up in our weekly forecast. If rates, on the other hand, start drifting below 6 into the 5s, this line may adjust down over the next year. And really what we do is each week we use the latest weekly data and we can adjust where the forecast of the entire year based on the latest data. So that's what we're looking at here. Really, it seems like we probably won't get back to our normal levels. And normal levels of the last decade were about 1 million homes on the market in the end of the last decade, 17, 18, 19. It was really more 900,000 homes. And so we'll get closer to that. I don't see us getting that unless we get rates that stay high all summer long. So maybe 700,000, probably less than that right now, is what the forecast looks like. So that means for buyers right now, significantly more opportunity than they've had in 3 years, less competition, but not any big flood. There's not suddenly a big wave of available inventory for you to swoop in and lowball. It just like doesn't exist because the sellers don't have to sell. This forecast assumes that like there are some fears, I think legitimate fears of a coming recession. While at Altos, we don't forecast recessions. We're not macro forecasters in that sense. If you can assume that there's a lot of signals of potential recession coming, jobs right now, people are very well employed in the country, incomes are rising, and unemployment is very low. There have been some layoffs in especially in the tech sector and finance, and it could be that job losses accelerate later in the year as an economy slows. The observation for the impact on inventory is that, let's say a recession really starts to be noticeable in the 3rd quarter or the 4th quarter this year. We have then companies start laying off. Layoffs come in force maybe in the January or 4th quarter or 1st quarter of next year. And then the way job losses impact inventory has a big lag, 6, 9, or 12 months. If I lose my job now, and then it takes me a long time, at 90 days, and I can't find a job, now I start to be worried and not be able to pay my mortgage. I either start to think about selling or I go into a delinquency. And so if I go into delinquency, now I have 90 days before a foreclosure starts even happening. So you've got a 6-month window for the earliest inventory really to be impacted after a pretty severe recession hits. So when we look at this curve, it assumes that a recession could be coming in 2023, but most of the inventory impact of that would be 2024 at the earliest. if that were to be the case. Something to keep in mind for your buyers, especially buyers who are thinking about economic catastrophe, and I'm going to swoop in and get a really good deal that I haven't gotten in years. That's something to keep in mind. On the demand side, we can look at the pendings. These are the homes that are in contract, and the way we've showed that each bar here is a week, the total number of homes in contract. The light portion of the bar are the newly in contract that week, and so we can see pendings dropping dramatically since May 30th, and we have only 238,000 single-family homes in contract right now. That's 34% fewer than last year. The biggest takeaway here is that the headlines, which are typically focused on closed sales, we can see that those are going to be pretty bearish, essentially keeping your buyers and sellers afraid of the housing market for several more months. Because there's few homes in contract now, this is a reflection of the activity from November and December. They then are in contract for 30 or 60 days or something or so, sometimes longer. And then, so they're in contract now. Let's say they close in February. That data typically gets reported in the headlines in March and April. And so we can already see that those headlines are going to be pretty bearish all the way through at least April. And so by tracking the pendings, what we can do when you watch our videos each week is we'll keep our eye on this, and we can use this as a leading indicator for actually, are those buyers, which we've been talking about a lot of anecdotes from realtors around the country, talking about a lot of people in the open homes, a handful that talked about price. I saw folks talking about pricing a little bit higher, having multiple offers this week. Some of those signals, and we'll see it show up in the pendings data each week before the headlines come. So keep your eye here, because the implication is that the headlines are going to be bearish for several more months, even if the leading indicators in the data are actually turning around a little bit. And so like pendings is one that's really for us to keep our eye on. Let's talk about pricing. The median price of single-family homes in the U.S. is $409,000 right now. That ticked up this week, and is actually still 10% higher than last year at this time. And the thing that we like to watch in January is the new listings as they come to market. They're really a signal of all of that, the sellers and the listing agents, all that we can see of the demand that's out there. We know that there was a lot of traffic at the open home. We know that the one down the street had multiple offers or had no offers, and therefore we price the new listing appropriately, a little bit higher. Our comps are pretty good because of last week, or they're lower. We don't have comps. They're still December. And so in the light colored line here, that's the price of the new listings. And you can see last year at this time, it was skyrocketing, spiking up higher than the dark red line, which is that first time it actually got higher than the dark red line. And that was the peak of the frenzy, January and February of last year. Then you can see in March, April, it turned sideways and started drifting back down. So right now, the median price of the new listings is $375,000. And we're going to watch that, especially over the next couple of weeks, to see where how much pricing resiliency is in the market. And, because this is active pricing, this is ask pricing. These are homes that get listed now. They may take offers in February. It closes in March or April. And, the headlines, April and May, is when you start to really see that pricing firming. So by focusing your buyers and sellers on this is what's happening right now, is really an effective way to communicate. Like if you walk into the US today and you look around at all the single family homes on the market, the median price is $409,000. It ticked up from last week. It is obviously off the peak from the summer peak that happens every year, but there's no sign in the data nationally of any kind of price cratering from here. Like I said before, we will go look at the local markets in a couple minutes and then dive in and show where there are some places around the country where prices are still correcting down. One of the leading indicators that I like best, and if you've watched any of our videos, is the percentage of homes on the market with price reductions. Normally around the country, you can see in this chart, this is a chart where each line is a year. Normally about a third, 30%, 35% of homes take a price cut before they sell. And sometimes that's intentional, and sometimes it's accidental, and sometimes whatever the crazy seller is the reason, but about a third. And when demand is hot, fewer than that need to take a cut. The crazy seller overpriced and said, let's try to get an offer, and they got their offer. They don't have to take a price cut. So what's happening right now, and you can see this year is the dark red line. It's at the far left end of the chart, is the current price reductions. I have a typo. Current price reductions is at 35.8% of the market. And that's the fewest we've had since July of this year. So price reductions peaked in July and ticking down. Peaked late in the year and are ticking down, but ticked down pretty quickly in the last few weeks. That's a reflection of more of those homes going into contract, needing fewer and having more things like multiple offers, and fewer of them sitting around without offers and feeling like they need to take a price cut to get attention. So what's interesting is we're still significantly more price reductions than we've had in any recent year. That implies significantly cooler conditions, fewer buyers than any recent year. So it is okay to communicate that with your sellers and with your buyers. Like, it's definitely cooler than it has been in a long time. On the other hand, 35% of homes with price reductions is not that scary. Like, it doesn't forecast any kind of like big pricing crash. It's falling pretty quickly. It's falling faster, frankly, than I expected. It's a steeper down. And what happens is in the spring, January, February, March, you get fresh inventory, and fresh buyers. And so you have fewer price reductions. Now, if those homes are still on the market in April and May, now you get more price reductions. And so you can see each year price reductions kick up in the second quarter. They peak in the third or maybe the fourth quarter, and then they decline again for November and December and into January. So that's this annual cycle on price reductions. So falling pretty quickly right now. And so the interesting thing is, if I am looking, where you can see last year, the light red line is last year, you can see starting in March, it diverged from the year before. So you could see that second week of March, all of a sudden price reductions tick up when they didn't in 2021. That was the first indication of, there's softening. We went from ultra hot to a moment of the first step of softening, and it shows up right here in the price reductions data. So we're going to see if this continues to fall quickly, if it flattens out in the mid 30s, which I think it probably will, right, mortgage rates are still higher. It's still significantly less affordable, mortgage payment wise, to buy a home than it was in the last few years. Demand is still significantly fewer. So like those things all imply that our price cuts are going to have to stay there. But they're not in the 40% range nationally. If they're in the 40s, now I'm worried about dramatically less demand and future price declines. So that's what this is telling us right now. Price reductions are also very local. And so, in fact, let me go show you a local view of price reductions around the country. This is the Altos system, the backend system. So if you're an Altos client, you'd log in and you'd have all your reports. You'd have your contacts that are getting your Altos reports, the campaigns, the email campaigns that go out with them. And this is our new advanced analytics platform. You can now buy you have advanced analytics in your Altos subscription. If you're already a subscriber at our county level premium or higher, you already have access. If you want to upgrade, you can upgrade today and get access to it so that you have, you can build the charts and the advanced analytics like I have done here. What I like to do is I have my rank charts that I've built. And in this case, I've got my 50 top 50 price reduction markets around the country. What it tells me really quickly is the absolute level. These are 53% of the homes on the market that have had price reductions. But it also gives me a 3-year view and the trend. Look at this, how steeply in Phoenix, how quickly price reductions started jumping last year. Price reductions peaked in Phoenix over 60%, 62, 63% last fall. This was when rates went from 5.5, 6.5 over 7. Then in December, they started coming down, and we could see that the market started adjusting again. Phoenix generally, because has bigger investor activity, has a lot of out-of-town buyers. Phoenix generally has higher than average price reductions. So normal in Phoenix might be 40% of the market. Last year, at the beginning of the year, it was 20% before it went up to 60. So 60% of the homes on the market take a price cut. So what we can see in Phoenix and Boise's the other one that was so crazy last year that way. We can see that it's ticking down, meaning there's slightly more buyer activity. We know that we have the spring market that price reductions will keep falling down. And we can see that as a whole, a lot fewer price reductions around the country. The American West and a little bit of the South is where the biggest pandemic boom was, and it's where the slowdown happened most aggressively. So Tampa, Winter Haven, Florida, Jacksonville, you can see all of those markets were dramatically higher and are starting to ease back down. We're going to go into a bunch of those local markets in just a minute. Let me do a few more national bits of data, and then we'll jive back down into the local reports. Days on market. Days on market is now at 77 days. It's climbing quickly. It is higher than it has been during the pandemic at any point, and ratcheting up. We know that days on market it is a price range factor, and I'll show you the market segments in a table. But what I wanted to show today is this is days on market nationally. I built this chart in the advanced analytics that I just showed you, and I just grabbed the national number and I grabbed the high end of the market. That's the first quartile, the top of the market. These are the $1 million homes, and comparing it to days on market for the low end of the market. You can do this for any zip code in the country, any city or county. And what we can see is last spring, every price point was down here in just a few weeks selling. Then very quickly, the high end of the market slowing much more dramatically. But the thing I wanted to show here is how much further from say 90 or 100 days to a normal range for the $1 million homes, that the top segment of the market is very often at 120 days, 130 days. And so because all of the stuff everything got bought last year, there's stuff that hasn't been sitting around for 2 years at some of that expensive side. So there's a lot of room to grow there. So one thing you can see is the divergence, the green line and the black line, meaning everything slowed down, but the green line is still, like in its pandemic peak time, where the high end of the market still has a lot of room to grow. Let's dive in a little more. Oh, before we do that, let's look at rents real quick. Rents this week, rents have been falling last fall, but are up 5% year over year. They were spiking early last year. They hit a peak in the late summer. So What this shows us right now, the last couple of weeks, the rents have been ticking up. And this is single family homes, the dark red line. That is so 2195 across the country. These are asking rents. And what so it's interesting to note that they have been ticking up. And that is what happens, of course, is we sometimes want to think about rents and home prices as alternate. Like if I can't buy, I'm going to rent, and that's going to drive up demand on rental. But that's actually not how it works on the prices. They actually move in tandem. And it's really a function of like, if I'm going to create a household, I might rent, I might buy, but the demand for household creation works at the same time. So what's interesting is to see rents ticking up at the same time as home prices have ticked up in the last couple of weeks. It shows us that there is that home buyer activity is showing up in the rental as well. It's an interesting trend to keep our eye on, especially for things like investor clients. So investors backed way off in the last year, and they're worried about plummeting prices, and they're worried about rents in a recessionary economy. What we can show right now to investors is like both of those things have stopped. If you have investors on the fence, it might be an interesting bit of data point to get them. There is a rental data point in every one of your Altos reports, so you can go get that as well. All right. As I mentioned, you can do all of this data. You can learn about all the data and how to talk about the data in the ebook, the Altos ebook. There's a link to the ebook. It will be in the chat, so go grab that. Knock yourself out. Dive in there. Lael will post that in the chat. Okay, let's look at some local reports. I've got a bunch of local reports up. And I want to start on the East Coast today. I was talking with my friend Heather Elias this week, who's an agent in Loudoun County, Virginia. Loudoun County is suburban and exurban DC, Washington, DC, in Virginia. And she pointed out that the inventory in Loudoun County there's only 185 single family homes available for sale to buy right now in Loudoun County, Virginia. There's almost 500,000 people that live in Loudoun County, and there's 185 homes for sale. And as I pointed out, the new listings rate is very low. So new sellers there's no sign of a lot of inventory coming. So the East and the North and the East of the US, inventory levels are still very much in their pandemic crisis low. And a lot of buyers have no idea. A lot of people are watching the headlines, thinking about the market slowing, or watching people talk about the changes in Austin and Phoenix and think it applies everywhere across the country. It does not. So, there's 500,000 people or 400 and some thousand people in Loudoun County and 185 homes for sale. It's a really dramatic thing. And if we look at the market action index, the speedometer shows supply versus demand. And you might be surprised that this is a seller's market, but if you're a seller in Loudoun County right now, you have very little seller competition. You have interested buyers. You have, if you price right, you've got a lot of opportunity. It's a really fascinating time given the media news about the economy and about the housing market. A really fascinating time. Here's the other thing is we look at I was talking about the days on market by price range, and I showed you the chart nationally, but here's how the table looks in Loudoun County. High end of the market is, these are $3 million homes on big land. It's exurban, and these guys are now 100 days, but look at this. You're on now smaller lots getting closer to $1 million, 21 days. Like I can tell you exactly where the demand is in Loudoun County, and we can see that the stuff that the even lower prices moving quickly, but actually the demand is right here. And using that for communication to your buyers and sellers is really powerful. That was a really fascinating look that Heather pointed out to me. Let's move over to Charlotte. Charlotte, North Carolina, had a lot of big pandemic inbound migration. And we can see that Charlotte has slightly more inventory than in the last couple of pandemic years. The little dot here is the year over year. By the way, these are my Altos reports. These ones are branded for Altos, but all Altos clients are branded for you. So Heather Elias has them branded for Heather, and they go out to her clients so that her buyers and sellers, so they can see what's happening in the market. What we can see in Charlotte is that just pre-pandemic, 4,000, 4,500 homes, 5,000 homes, and now we're at 3,200. So we're still significantly lower inventory than in the pandemic time. We can see, though, that because of that, it's not as strong a seller's advantage in the Charlotte metro area. And down in the price segments, there is a much flatter distribution than Loudoun County. Loudoun has those $3 million and has a significantly tighter or broader range. And so in the Charlotte metro area, we have the high end of the market at 750 is still a couple of months long, but even in the mid range here, they're still about the same. And so the demand is much more evenly sparsed. So, but let's look at Tampa. So in Florida, Central Florida was super strong in the pandemic, and then as at the investors and the people moving, the New York people moving to Florida, as that declined, now we can see a market where the Tampa inventory is basically where it was pre-pandemic. A little bit fewer, just under 8,000 versus just over 8,000, but a ton. So if you're a buyer if you're a buyer or seller in Tampa, and you think that 2,000 homes on the market last year is normal, you think that 8,000 feels like a lot. 8,000 isn't a lot. It's normal, but it is significantly different. And we had this climb and last year that was really putting the brakes on, and really it's in a lot of these markets. You can see it's really investors that stopped making their buys, worried about price changes. Let's look at pricing in what's happened in Tampa over the last few years. So Tampa had dramatic price increases, had its peak last May, and then has easing back down. Notice the curve here is flattening. This time of year is really when prices would increase in Tampa. So you could imagine that maybe we get a little bit of price increase, but we don't see right now, we don't see prices still on a downturn. So that shows me leveling off, demand leveling off in Central Florida. Supply is more, but not huge. And again, no big sign of big surge of inventory coming. Let's go up to Philly. The Philadelphia metro area is another one of these markets that on the east and the north central inventory over the last few years is in Philly. We're still 6,200 homes. We're still at the pandemic lows. This is crisis low inventory. So if you're a buyer seller in Philly, you have to know that inventory is still significantly restricted compared to normal, half of what it normally would be at this time of year. Like, that's a really big deal. We can see that the days on market has climbed, but it's peak time, and that should start easing back down. We can see that here in Philadelphia, the rents are about where they've been over the last year. And we do know that market action index has ticked down because supply is low, but demand has obviously been low as well during the last 6 months. All right, let's move to the West Coast. Here's Phoenix. Phoenix was, of course, one of the biggest boom markets during the pandemic and one of the markets that slowed the most aggressively. Phoenix has a ton of investor activity. It has the iBuyers, has all of the signals of the folks who will want to stop as quickly as possible. What we can see in Phoenix is, because last year, May, June, as those buyers backed off, prices corrected down. So prices, median price in the Phoenix metro market is lower than it was during the last couple of years. Now, pre-pandemic, it's still higher than before the 2020, before that pandemic move. This is the little first pandemic few weeks window. But we have given back a couple of years of price gains in Phoenix, because really, like, that was the demand that backed off. But we can see ticked up this week. That price curve is flattened. Does not look like, at least at this point, with rates where they are, that there isn't signal of pricing tanking from here. It looks pretty like we've hit a place where the current mortgage rate and affordability, especially for like in-town buyers, move up or move down buyers who are staying there, as opposed to the investor crowd. Like it seems like that's where the activity is in the Phoenix metro market, and the signals look like that. Look significantly less scary than last year for people who've been watching. San Diego is maybe the hottest of the California markets, where San Francisco is maybe the coldest right now. Inventory in San Diego is a little bit higher than where it was, last year at this time, less than 1,000 homes for all of San Diego, but has really, we saw the big run up last fall, and really aggressively people buying in San Diego. Watch this inventory really start to decline pretty aggressively. A lot fewer, and San Diego and the coastal California markets have a chronic shortage of homes for sale. So it is unlike Phoenix. There's only 2,700 homes on the market for all of San Diego in normal times. And so, we're still significantly less than that. So you can really see the demand there in Phoenix, or in San Diego. And let's look at the pricing trend. Here is the multi-year pricing trend up this spring with the demand as inventory started cratering. We can see that the prices start to kick in this spring, higher than last year and significantly higher than pre-pandemic. So you can see really the demand happening in a place like San Diego. I'm going to skip Salt Lake and go to Boise. Boise was maybe the poster child of the pandemic boom markets. These were California migration to Boise. I can buy anything I want in Boise when rates are at 2.8%. I can overbid by $150,000 and it doesn't impact my payment that much. There's a lot of that activity that then evaporated very quickly. And the percentage of homes with price decreases is the one that I wanted to focus our attention on in Boise. We can see that normally Boise is actually a 40% or 50% market with price reductions. During the pandemic, it's down here at 7%. 40% of the homes think they're overpriced. And we have all of these bidders last year, and only 7% need to take a price cut. Because if I'm moving from LA, I'll take it. It's 3% mortgage rate, I'll take it. Then we can see, that was 2 years ago. Then we can see last year was about 13%, and then a dramatically increased price reductions during, as the market slowed, as those out-of-town buyers stopped cold, inventory built very quickly. I got to cut my price to see. Now with rates at 6.5, now overbidding is very expensive to my payment. So bidding over, $100,000 over, now I feel that every dollar in my payment every month. So all of that bidding war activity goes away, and people become very sensitive. It is ticking back down as we have fresh inventory for the spring, but still pretty high. One of the highest markets in the country for price reductions. So, Boise isn't out of the woods yet because the out of town buyers may feel that. We have given back, though, different from Phoenix, really only about a year's worth of that price increase. And it'll be interesting to see. So here's 2 years ago. Price is still higher than 2 years ago. So anybody that bought in the last couple of years is still in a pretty solid place in Boise. If you bought February of last year, that's you're locked in with your cheap rate, fortunately. But your prices are just down pretty dramatically since then. And so it'll be a long time. You may sit on that home for a long time. Let's do Austin and then wrap up with San Francisco. And if we look at Austin, just basically a balanced market, supply and demand at this point, and which feels funny because it feels like Austin froze cold. But we can look at the inventory levels. Austin is one of those few places that has more inventory than the beginning of pre-pandemic. So inventory rose dramatically during the last year when rates rose, and now they're starting to ease back down. We're going to ease back down for the next few months into a more normal range. You can see days on market at all price points in Austin has slowed way down. And so, maybe the little more activity down here at the $350,000 range. And you can see barely, we're at basically a balanced market, maybe slight seller's advantage, but in the market action index. So, what we say, especially if you're listing a house in Austin or you have buyers in Austin, you say, look, you want to watch this every week. If this market action index is ticking down while we have your house listed, that's the market giving us a signal that your buyers are fewer and your seller competition is increasing. And if this is ticking down, especially if it starts ticking down below 30 while we have your house listed, that's a real signal that we may want to do a price change to get ahead of this curve. It's a power that you can hand to your sellers to make decisions based on what's happening in the data right now. It's a really interesting way to look at the market for them. Really handy. I'm going to put this report in your inbox every Monday while we have your house listed. I want you to keep your eye on that. On the other hand, as buyers, if that thing's ticking up while you're searching, that's the market getting hotter. And so it may indicate that you want to take action now and not wait for, some imaginary big chunk of inventory to come to market. Let's finish up with San Francisco today. San Francisco is one that I was looking at this week. I'm looking at condos in the city of San Francisco proper. And as San Francisco is probably the biggest market hit most dramatically by a work from home transition. The tech companies that are very easy to work remotely. And we can see how condo prices in San Francisco, this is price per square foot. So up here at $1,200 a foot pre-pandemic is starting to get around $1,000 a square foot now, significantly lower than last year at this time. And so that's a real signal. And we have not seen that turnaround in San Francisco yet. So, where we can see the green shoots of, those in a lot of the markets, in places where still have big remote work happening, it can be the San Francisco condo market, it can be a long time before we recover a lot of those in there. And I thought that was a really fascinating bit of the story because, for a lot of people, they think the whole country looks like this right now. And it's a really select few places that need to be. And you can see days on market, 100 days in every price point in those condos in the city. It's a really, and this is even more dramatic if you look at the downtown condos in San Francisco. Okay, that's a ton of local data that we did and I will let me go back here. If I didn't get to your local market, you can go to altosresearch.com. You can sign up, you get your data for your local market and just book it, right? Your clients need to know this right now. Your buyers and sellers need to know that local market activity. It's every week, so it's in their inbox. It helps them make decisions, and it's not just you as the realtor saying, well, there's a lot of activity at my open house. It's like, I can show you in the data what's actually happening here. So that's really what you want to do. The next couple of weeks, keep your eyes tuned to our videos on YouTube, because it'll be really fun to watch how much inventory is coming to market, where they're priced, what's happening to those price reductions. Do those start ticking down? There's a lot of signals that happen now. The best inventory starts getting listed in the next few weeks. That happens for the first sales in the first quarter. The second quarter is the peak of the market. And so we could get a lot of signal for the rest of the year in the next few weeks. All right, that's all the data we have time for today. I will stick around in the chat to make sure we got all of any questions answered. Thank you so much for attending. I really appreciate all of your